for companies with tax payable and a cash grant of $5,000 maximum, but subject to 5% of your revenue, so whichever is the lower. Now the 5% revenue is to take into account that quite a lot of companies in Singapore are dormant companies. So if you do not look at the 5% revenue, then dormant companies will also be entitled to the cash grant of 5,000. Question, how do we define SME? Well, our MM said in Singapore we have no Fortune 500. Therefore, in Singapore, all companies are SMEs. Yes, I'm not kidding. So all companies are entitled to the 5,000 cash grant. So I was wondering, why was it called an SME rebate, or SME cash grant? Then I linked it to the coming election. Then for SMEs, they always complain they have not been taken care of. So this is how they are being taken care of, but it applies to everyone. Because MM said we have no top Fortune 500 companies. But that's correct. So let's look at how the tax rebate and SME cash grant interact, because we have to look at both. So let's look at example A. A Limited, it has revenue of 4 million, chargeable income $500,000, so tax payable 59,075. So 20% rebate equals 11,815. But the rebate is kept at 10,000, so A Limited will be entitled to a rebate of $10,000. B Limited, it has revenue of 1.2 million, no chargeable income, therefore no tax to pay, and 5% of its revenue is 60,000. So when we look at cash grant, the maximum is 5,000. So we take the lower of 5% or 5,000. So B Limited will be entitled to a cash grant of 5,000. Now C Limited, revenue 400,000, chargeable income 50,000, 20 tax payable 3,825. So 20% tax rebate is 765. 5% of revenue should be 20,000. 5% 20,000. Maximum cash grant 5,000. So we get the lower of rebate or of 765 or cash grant. So now C Limited will be entitled to the cash grant. So you can see here that even for tax paying companies, they can be entitled to the cash grant, because we look at the higher of the two. Rebate, in other words, if your tax payable is more than 100,000, definitely your 10,000 will be the higher. But if your tax payable is below 50,000, then your cash grant will be the higher. So let's look at C Limited. C Limited, revenue 75,000, chargeable income 10,000, tax 425, 20% rebate on tax payable $85, 5% of revenue. When we look at the cash grant, 3,750, maximum 5,000. Now the rebate is less than the cash grant, so we get the cash grant, but we take the lower of 5% of revenue or 5,000, whichever is the lower. So now the cash grant will be 3,750. So that's how the cash grant will work. Now, productivity and innovation credit. This PIC was introduced in 2010. It was then already a very generous measure, because when it was introduced, we could get up to 250% deduction for up to 300,000 per qualifying activity. And we have 6 categories of activities: research and development, acquisition of IP, registration of IP, investments in design, industrial design, product design, investments in automation, and training for employees. So as you can see from here, especially with the acquisition of IP and investments in automation, we would be able to claim capital allowances, so our entitlement to capital allowances will be enhanced. And in the recent budget, the Minister has increased the percentage from 250% to 400%, and the maximum quantum per activity from 300,000 to 400,000. So it's a very, very generous scheme. And if you look at the scheme itself, we are really looking at a step up from our development. The emphasis is on research and development, intellectual properties, design, training. All these will push our economy to the next level, and that is the whole intention of the PIC. Let's look at how PIC works. So I have an example here for automation equipment. So the maximum available is 1.6 million because it's 400,000 of 400% of $400,000. So say for example, we acquired automation equipment of costing us 400,000, and automation equipment qualifies for 100% capital allowance. So for PIC, that will be known as the base allowance, the 100%. And now we are entitled to another 300% enhanced allowance, 1.2 million, now giving us $1.6 million of total capital allowances. Base allowance, 100%, enhanced allowance, 300%. The catch here is the equipment must be owned for at least 1 year. Well, 1 year is not a long time, so I would suggest that when we invest or your clients invest, make sure that they are mindful about the 1 year requirement, because if the equipment is disposed of within a year, the enhanced allowances will be withdrawn. And of course, when we compute capital allowances, when we dispose of assets, we will also have a balancing charge, because after deducting 100%, our written down value is 0. So whatever we sell it for, we will have a balancing charge. So let's look at the example that we had earlier on. So let's assume we purchased it in July 2010, and we make up accounts to 31st December. So this falls into the first year of PIC, YA11. So we have equipment costing us 400,000, base allowance 400, 100% claim. So our WDV is 0. But we are entitled to the enhanced allowance of 300%. So now the total allowances available in YA11 is 1.6 million. If the equipment is disposed of end of March, so it's disposed of within a year, there will be a clawback. So first, our balancing adjustment, written down value 0, sales proceeds say 280,000, the whole 280,000 will be clawed back as a balancing charge. And the enhanced $1.2 million will now be deemed as income accessible to tax. Last year, we claimed it as enhanced allowance. We got a deduction. Now, it will be added back as deemed income. However, if instead of disposing within a year, we dispose of it just after 1 year. So after 1 year, we will still have our balancing adjustment, compare sales proceeds with written down value. So the sales proceeds of 220,000 will be withdrawn. But because we have disposed of our equipment after a year, there will be no clawback of the enhanced 300%. So it's not difficult to keep it for 1 year, so be careful. For intellectual properties, for automation equipment, make sure you keep it for at least a year. Now let's look at PIC for intellectual properties. Intellectual properties, we can claim allowances under Section 19B, and 19B provides us with a 20% claim per year. So straight line, 20% over 5 years. So if we purchase an IP costing us $500,000 and we acquired this in July 2010, and again, our counting period is to December. IP costs $500,000. We can claim base allowance 20% of $500,000. So we have 400,000 written down value. But we are also entitled to enhanced allowances of 300%. But this 300% is only good for 400,000. So we get another 300% on 400,000, but not on the excess 100,000. So we have another 240, giving us total allowances of 340,000 for YA11. Same as for automation equipment. If we dispose of it within 1 year, the enhanced allowances will be withdrawn as deemed income, and we will have to do a balancing adjustment to compute either balancing charge or balancing allowance. So again, make sure we dispose of it. Hold it for more than a year before disposal, because then our enhanced allowances will not be withdrawn. So the 1 year is not long. I always emphasize to my clients, so make sure we keep it for 1 year, because it's very seldom the government gives you handouts. This to me is a very, very important handout to encourage us to automate, to encourage us to purchase intellectual properties for use in our business for exploitation. Alternatively, we can convert our qualifying expenditures into cash, and the conversion is up to 30,000 for YA11. So it is on the first 100,000 of expenditure. So now when you multiply 100,000 of expenditure with 400%, so we are actually converting 400,000 of allowances to cash. So our effective rate of conversion is actually 7.5%. Now our corporate tax rate is 17%. So if we know that we are going to be profitable, so maybe we are not profitable in YA11, but going forward we will be, then we should not convert, because the conversion rate is only 7.5%. And this is more important for sole proprietorships, for partnerships, because if the sole proprietor, the partner, is being taxed at the marginal rate of 20%, even though this year is not good, he should not convert, because his future usage is a lot more than the effective tax rate of 7.5%. Now, because the PIC now is good for between YA11 and YA15, and it was only introduced last year, so the minister, in fact, in his last year's budget, has indicated that the PIC can be grouped together. So for YA11, YA12, we can group the 400,000 together, so giving us 800,000. So if we did not invest in automation equipment in YA11, we actually can invest in YA12 and claim up to 800,000. And for YA13, 14, 15, grouping the 400,000 together, we have 1.2 million. And this is 1.2 million multiplied by 400%. So it's a lot of allowances to look at. So businesses looking at training, looking at R&D, investments in automation, you should make sure to take advantage of this. Now, the other very interesting proposal is the pooling of foreign tax credit. This is in respect of the taxation of overseas income. Up until now, when a company claims double taxation relief or unilateral tax relief, the credit is computed source by source, country by country. So, for example, if we have two sources in one country, we have to do two computations, and if we have another 3 sources in another country, we have to do another 3 computation, because it's source by source, country by country. And that source by source, country by country results in the foregoing of a lot of foreign tax credit. Because as we can see from our earlier slide, most countries will have corporate tax higher than us. So when we receive dividends, the underlying tax alone will be more than 17%. So if you add on the withholding tax, which most countries will impose, we are losing a lot of credit. But with this pooling, it is actually very, very interesting. Let's have a look how this will work out. So at the moment, say for example, A Limited, it has Singapore income $500,000, overseas interest remitted, suffered withholding tax of 5%, remitted 95,000, and we have overseas dividends remitted 100,000, and the withholding tax in the overseas country is 10%, corporate tax is 30%. So we will first have to gross up our overseas income. So interest income grows up to 100,000. Dividend income grows up with the withholding tax and the underlying tax. So now our regross overseas dividends amount to 158,730. So when we compute the tax for A Limited, we must take into account the regrossed overseas income. So our total chargeable income is 758,730, less of partial exemption of 152,500. We have tax payable of 103,059.10. Now, foreign tax credit, we must claim source by source up until now. So for interests, we have to find out how much of the Singapore tax is attributable to the interests. So attributable is 13,583. Overseas tax suffered 5,000. So DTR will be the lower of the two figures. So we get a credit of 5,000. For the dividends, Singapore tax attributable 21,560. But the overseas tax suffered is 58,730. But DTR is the lower of the two, Singapore tax imposed or overseas income suffered. So now we get DTR of 21,560. So you can see that just over 27,000 of foreign tax credit is gone. We suffered 58,730, yet our credit is only 21,560. So when we compute a tax payable, tax 103,059, less of the DTR as computed, we end up with net tax payable of 76,498. But with the pooling, what we actually will do is to pool our income together. overseas income. So pooled together, we have 258730. The Singapore tax attributable is 35143. Actual overseas tax suffered for the interest and dividend amounted to 6370. So now we get double taxation relief of 35143 as opposed to the earlier 26560. So about $9,000 more. So you can see from the new pooling system, it is actually very, very interesting. Some of my friends ask me, well, how much does it cost the government to implement the pooling measures? My answer, it doesn't cost the government anything. And that is an honest answer, because up until now, we will always tell our client, if your foreign tax credit is low, don't remit your income, because we only tax overseas income when they are remitted or deemed remitted. So no loss in revenue, but with this pooling measure, the government is actually trying to encourage companies now to remit the overseas income, because you can pool it with higher tax overseas income. So two things to note. In the past, we have been claiming tax exemption for the foreign source income exemption under Section 13(8). So under those measures, we say, okay, we will remit back income which has suffered tax, or the overseas jurisdiction has headline tax of at least 15%. But don't remit income that suffered tax at, say, 5%, interest income, royalty, 10%, because we end up having incremental tax to pay. But now it is the reverse. You should not be claiming 13(8), because when we claim 13(8), as you can see from the overseas dividends, we have a lot of foreign tax credit. So if we claim 13(8), the excess foreign tax credit is gone. So what we should now do is to look at our higher tax overseas income. Don't claim 13(8). Look at the lower tax income, try to pool them and equalize and bring in a mixture. And that is very useful under the pooling measure. And that's when I refer to as the timing of remittances. So you must time your remittance, because overseas income is taxable on a remittance or deemed remittance basis. So going forward, unless you have no lower tax overseas income, do not automatically claim 13(8) exemption. Pre-commencement expenses. When we incorporate a company, and then it will take us months, depending on the type of business you are in, sometimes more than a year, before we actually commence business. So example, if we incorporate a company 1st July 2010, and then we have the first 6 months period ended 31st December 2010, and then next year, 31st December 2011. If we actually commence our business on the 1st of April 2011, under the pre-commencement concession, if we incur pre-commencement expenses which would have been deductible had we commenced business, within the accounting period in which commencement took place, we can get a deduction. So if we look at the time scale, we have two accounting periods, one a 6-month period, and next a 12-month period. So we commence our business on the 1st of April. So the pre-commencement expenses from 1st January to 31st March would be expenses incurred within the accounting period in which commencement took place, deduction available. Now the Minister has enhanced that to say that even for pre-commencement expenses incurred in the accounting period preceding the accounting period in which commencement took place, we can also get deduction. So now we can even go back the previous accounting period for pre-commencement expenses incurred from 1st July to 31st December 2010 if they can satisfy Section 14 and not precluded by Section 15, we can get pre-commencement deduction. Because all these expenses will then be deemed to have been incurred on the first day of commencement. Now this is an interesting adjustment because when we had 14P legislated, I think it was legislated 3 years ago, the requirement was a company can get a deduction for treasury shares used in satisfying employee stock option schemes. But it had to be treasury shares. We have a lot of clients where the holding company will set up a special trust or special purpose company to buy shares in the open market with a view to satisfy the stock option requirements of employees. So if you look at the technical side, these expenses would not be deducted because 14P talks about treasury shares. So what the minister has proposed is for special purpose vehicles and trusts that acquires shares in the market so to satisfy employees' equity-based remuneration will also qualify for deduction. So when we talk about effective YA12, it is already effective now because we are in the basis period for YA12. The next scheme is to enhance our attractiveness as a financial center. Up until now, interbank payment of interest is exempt from withholding because under domestic withholding requirement, if we pay interest to a non-resident, we have to withhold tax. But to grow our financial services, we have an exemption where if Singapore banks, be they Singapore actual resident banks or foreign banks, pay interest to their counterparts outside of Singapore, non-resident banks, they're exempt from withholding. So now this exemption from withholding is extended to interest payments made by banks in Singapore to non-banks, principally hedge funds, institutional investors, private equity funds. So again, with a view to grow our financial services sector in Singapore. Now this is similar to the consolidation of financial services incentive. So now the minister has proposed that the shipping incentives will be consolidated into the maritime sector incentive. So we have incentives such as exemption from operations of ships, whether they're Singapore ships or foreign ships, ship financing, then we have concessionary tax on leasing of containers. So all these will be consolidated into MSI. Global trader incentive. Up until now, profits from derivatives trading would not be considered as income arising from the global trading. Usually, IE will be looking at spot trading, futures trading, and physical, not derivative. But the minister has recognized that with trading being more sophisticated, traders have to participate in derivatives trading, hence the inclusion of derivatives trading as qualifying income for a global trader incentive. Now this global trader incentive is administered by IE, so if you have clients dealing with commodities, bulk chemicals, you can apply to IE for the incentive. Finance and Treasury Centers. Now we have this Finance and Treasury Centers now for close to 25 years. It was introduced in the late 80s. About 3 years ago, the government liberalized the qualifying income to include income from local network companies. but on the proviso that the local income revenue cannot exceed 10%. If it exceeds 10%, then that income will not be considered as qualifying income for FTC purposes. Now, what the minister has done is to redefine the income to exclude related party transactions. So related party transactions will be excluded in the same way that we exclude them for consolidation purposes. And that is actually a more accurate way of measuring the revenue of the local network. Because, say for example, a typical Japanese companies, they will sell probably 100% of their product to the sales arm before they sell to third parties. So now with this exclusion, that company can be a qualifying network company. Donations. In the past, donations of 100%, we got up to 200% deduction. In 2009, because of the very, very bad recession, the minister tried to encourage individuals and companies to be more philanthropic by increasing the deduction to 250%. And that was initially introduced in 2009. He extended it to 2010, and now he has made the 250% good until 2015, extended another 5 years. Well, I am not sure why he wants to put a time limit to it. To me, I would think it's quite fine to say 250% henceforth. But this is